Swayam Prabha. Digital India. Educated India.
Hi everyone, welcome to this session. Today we turn our attention to one of the most critical levels of macroeconomic management, that is monetary policy. So for firms and businesses operating in a dynamic economic environment, understanding how central banks influence money supply, interest rates and credit conditions is essential. So these monetary decisions shape borrowing costs, investment sentiments, consumer demand, and even exchange rates. So all of which have a direct impact on business strategy and decision making. So in this session, we will begin by unpacking the concept of money supply and what constitutes high-powered money or the monetary base. Then we will explore the goals of monetary policy such as price stability, economic growth, employment, etc. So our main focus will be on the tools of monetary policy. There we will examine three conventional instruments used by central banks. It includes open market operation, reserve requirement, and finally discounting policy. So we'll also briefly touch upon the unconventional monetary policy tools which gain momentum, especially during economic crises, such as quantitative easing and forward guidance. So together, this lecture will equip you with a clearer understanding of how monetary policy shapes the broader economic environment within which businesses make strategic decisions, whether it's about investment or pricing, financing, or market expansion. So let's get started by looking at the foundation. So let us begin with the concept of money supply and the monetary base. So before that, policy and the other one is fiscal policy. So in this lecture, our focus is mainly on monetary policy, and this in some subsequent lectures as well. After completing that discussion, we will turn into fiscal policy. So as I mentioned, let me begin with the basic aspects, that is the money supply concept. So let us first define what is meant by money supply. So money supply means is a key determinant of interest rates, inflation, and overall economic activity. So the formal definition for money supply is that it is the total stock of money in circulation in an economy at a given time. Though we say supply, actually it's not a flow concept, it's a total stock of money in circulation in an economy at a given time. So, the Reserve Bank of India adopt various definition for monetary and liquidity aggregates. The one is called M1 money. So, M1 money means currency with the public plus demand deposits plus other deposits with the RBI. So what does it mean? Currency with the public means currency in circulation. Demand deposits means the savings bank account and current account. That means demand. It can be withdrawn at any time. The examples are savings bank account and current account, and other deposits with the RBI, mainly by Prime Minister, ex-Prime Minister, etc. Then we have M2 money. M2 money means M1 plus time deposits with maturity less than a year. So what is time deposit means? Time deposit means there is the fixed deposit that you normally will put your money in a bank for a given period of time deposits, and recurrent bank deposits. If the maturity period is less than a year, then we add this one with the M1, then we get M2 money. M3 money means M2 plus time deposit with a maturity of 1 year and more. Then obviously you will get a question here is that why are we including demand deposits? So the reason behind it, when you are defining money supply, is not only the money with the general public, because if the demand deposit, the savings bank account, so the money in your savings bank account, it can be withdrawn at any time. You can make online transaction using that money, and you can withdraw at any time. That's almost equivalent to having money with you. So that is the reason the money that you put in your savings bank account and current account are part of money supply. And similarly, time deposits, these days even time deposit, for example, you make a deposit with the bank for 1 year, and if you want to withdraw at any tomorrow or day after tomorrow, you can do it, but at a penal rate of interest. But the key characteristics here is that time deposit also can be withdrawn at any time. Right. So that also almost equal to money. So that is the reason we include time deposits with the maturity less than 1 year, as well as maturity of 1 year and more, all are part of money supply. So in short, with the money supply definition, we include not only the money with the general public, but also the bank deposits as well. The reason is that these deposits can be withdrawn at any time, or it can be used just as the money. It serves equivalent of having money with you. So in India, we call this M3 is called as the broad money supply, and this is the concept RBI or in India we use when we are measuring money supply in the country. I am giving you some screenshots of some money supply definition. This is for the US. It's almost similar to the Indian one, but there are slight variation. This is for money supply in Canada. I also detail here in a tabular form the supply of money supply definition RBI. That is the definition that we use in India. So all the details are given in this table. You please go through this and get a clear understanding how money supply is measured in India. So let's now move to another related concept that is called monetary base. It is also referred to as high powered money. So the monetary base means the currency in circulation plus reserves. So currency in circulation means currency in circulation with the general public. That is the currency with the general public, that is a monetary base. And the reserve means bankers' deposits with RBI, central bank, plus wall cash. So I have given the clear-cut definition, the further details of this concept. Bankers' reserve means required reserves plus excess reserve. Required reserve means especially the commercial banks in India, they need to keep a certain fraction of their total deposit with the Reserve Bank of India, is around 4.5% plus excess reserve. That if there is excess money with them, that normally with the central bank account, that will be treated as excess reserve. Then the vault cash. Vault cash is the cash physically held by banks in their vaults to meet deposit withdrawal demand. So this one is called the monetary base or the high power money, using this monetary base, the central bank of any country, they control the money supply in their respective country. So let us now move to another important aspect, the monetary policy goals. So before that, we know that who is the monetary policy authority. Normally central banks are the monetary policy authority in each country. So central banks play a crucial role in ensuring economic and financial stability. So they conduct monetary policy to achieve low and stable inflation and high economic growth. So this is the apex, this is the monetary authority, as well as this is the bankers bank, or we can also call it as apex bank, and it is the lender of the last resort for the banking system in the country. So for the commercial banks and other banks, in case they are falling short of sufficient funds to run, then the central bank will act as a lender of the last resort for them. So before moving further, let us have a few words about the Reserve Bank of India. Is the monetary authority of our country. It formulates, implements and monitor the monetary policy in the country. Its main objective is to maintain price stability and ensure adequate flow of credit to productive sectors. So, Reserve Bank of India is not only a regulator but also supervisor of the financial system, especially the banking system. So, its main objective is to maintain public confidence in the system, protect depositors' interest, and provide cost-effective banking services to the public. So now turning to the key goals of monetary policy, one of the main goal of monetary policy is price stability goal. Price stability goal, that is the main goal of monetary policy, that is price stability. So over the past few decades, policy makers throughout the world have become increasingly aware of the social and economic cost of inflation and more concerned with maintaining a stable price level as the major goal of economic policy. So here they use, in order to attain the price stability, they use some nominal anchor, a nominal variable such as inflation rate targeting or money supply is also called as monetary aggregate as the main anchor, which ties down the price level to achieve price stability. So apart from the price stability objective, other key goals of monetary policy are ensure stable economic growth and ensure high employment and output stability, and also to ensure stability of financial markets, and also to ensure interest rate stability in the country. And furthermore, another key important goal is to ensure stability in foreign exchange markets, especially the exchange rate for their domestic currency. So in general, there are two concepts have been widely discussed when it comes to the goals of monetary policy. One is called hierarchical mandate and the other one is called dual mandates. So because clearly here all these objective and mainly the inflation. One is the inflation, price stability, inflation, and the second one is economic growth. These are the two key objectives. So what happens here is that both objectives won't go together. Suppose if the economy is under recession and we want to revive the economic growth, the normally suggested remedial measure is reduce the rate of interest. So when the monetary policy aim to reduce the rate of interest, in order to pursue that, they will be supplying more money in the economy. They will be increasing money supply. So while doing that, while increasing money supply, the rate of interest decline. The other way also, in order to reduce the rate of interest, they will be supplying more money. So when the rate of interest is low, that means more money supply, that would revive economic growth. But at the same time, you know that if there is more money supply, that would lead to inflation. So if they want to give focus on economic growth, then there will be inflation. So if they want to reduce inflation, they need to reduce money supply. If they're reducing money supply, then that will increase rate of interest and that would adversely affect economic growth. So in this case, which one to prioritize, whether inflation, low inflation or high economic growth? So that means a hierarchical mandate. Hierarchical mandate means between inflation and economic growth, they need to choose one. So normally they choose inflation in some point of time. Some other period of time, they would prefer economic growth. That is a hierarchical mandate. So monetary authorities, they will be announcing that either they will be preferring prioritizing inflation control or economic growth. Then the other one is called dual mandates. Dual mandate is that giving an almost equal weightage to both. That is, long-term interest rates will be very high if inflation is high. This statement in practice is a dual mandate to achieve two co-equal objectives, that is price stability and maximum employment. Maximum employment means high economic growth, because high economic growth ensures maximum employment. Now, to achieve these goals, the central banks they use a series of policy instruments. We call it monetary policy instruments to get a better idea of how these tools have been used and how monetary policy have been implemented. So there is a linkage between central bank tools, policy instruments, intermediate targets, and goals of monetary policy. So you can see these are the tools of central bank. So one is open market operation, discount policy, reserve requirement. These are the three major conventional tools of a monetary policy which has been widely used across the globe. And then there is goals. These are the goals which we already discussed. Then in order to attain this, there are some policy instruments we will discuss after a couple of sessions. Then we will also discuss intermediate targets. So in this session, our focus is mainly on this first component, the tools of central bank. One is open market operations, second one is discount policy, and reserve requirements. The other three have been used in most other countries as well, mainly in US and other developed countries. They use these tools as well in addition to the first three tools. So these three tools are called as conventional monetary policy tools. So central banks typically use three key tools to regulate money supply and interest rates under normal economic conditions. One is called open market operation, or shortly we call it as OMOs. OMOs are buying or selling government securities in the open market by central bank to influence liquidity and short-term interest rates. Second one is reserve requirements, that is mandated portion of deposits that banks must hold as reserves either with the central bank or as vault cash. And third one is called discount lending. Discount lending means lending to commercial banks through instruments like bank rate or marginal standing facility. So let me go each one of it in detail. One is called the first one, the open market operations. So the formal definition is, I have given the formal definition here, is buying or selling of government bonds, treasury bills, and other financial instruments in the open market by the central bank. So the main purpose is to regulate the money supply and short-term interest rates by influencing the level of reserves in the banking system. So the mechanism is like that. If the central bank do an open market selling, if they sell the government securities that the central bank is having, by doing that, they withdraw the liquidity from the banking system. That means when they are selling, suppose if the central bank want to reduce money supply in the country, what they need to do that first they need to reduce the money supply with the banking system. That means the liquidity with the banking system. So when central bank sells government securities to the commercial banks, then that means the commercial banks buy the securities from the central bank. Then in return, it will be giving money back to the central bank. So that means when money with the banking system declines, then in the economy, the money that is moving to the flowing to the economy also declines. That one in order to tighten the money supply. So at the same time, if the objective of the RBI, the central banks wants to increase money supply in the economy, then they will offer open market purchase. So open market purchase means the central bank will purchase government securities from the banking system. You know that commercial banks, they invest a certain fraction of their total fund in government securities. That means they will hold government securities. That is more safe investment. So if the central bank wants to increase money supply in the economy, is first it will increase liquidity with the banking system. It will increase money with the banking system. So in order to do that, it make an open market purchases of government securities from the banking system. Then it will give, that means in return banks will be getting more money. That means the liquidity with the banking system increases. Then obviously you know that means when banks are having more money, they will be lending into the general public. So in order to increase money supply, a central bank will offer an open market purchase of government securities. So in India, RBI conducts OMOs to manage liquidity and guide interest rates in line with monetary policy objectives. The second tool is reserve requirement. So in Indian context, there is two types of reserve requirement. One is called cash reserve ratio. This is also called as RRR, required reserve ratio. It's a mandatory percentage of a bank's total deposit that must be kept with the RBI in cash form. That means it serves as a tool to control liquidity and inflation in the economy. For example, as of July 2025, CRR is 4.5% of a bank's net demand and time liabilities. Liabilities means deposits. So that means each and every commercial bank in the country, they need to keep 4.5% of their total deposit with the central bank. They cannot lend that money to anyone. Of their total deposit with the banking system, 4.5% has to be kept with the central bank to as a reserve. Suppose that means the remaining 95.5% only can be lent in the economy. So suppose if they increase this one to 10%, suppose if the central bank want to reduce the money supply in the country, so it increases to 10%. That means only the remaining 90% of the deposits, the commercial banks can lend only 90% of the deposit, not 95.5%. So if they want to increase money supply, they will reduce cash reserve ratio. If the central bank want to reduce money supply, they will increase the cash reserve ratio. In addition, there is statutory liquidity ratio, that is called SLR. It means RBI requires banks to maintain a certain portion of their net demand and time deposits in the form of liquid assets such as government securities, gold or approved bonds. They need to invest, but not in cash. So that means approximately 18% of the total deposits should be invested in most liquid assets such as government securities, gold or approved bonds. That means the remaining can only be lent to the general public. So that means you can see here that 18% in SLR, 4.5% in as a required cash reserve. So that means the remaining amount can only be lent to the general public, which affects the money supply. And I am also showing you the reserve requirement in the USA. There in fact is based on the size of the bank. Those banks who are having deposits up to 16.3 million, they don't need to keep any reserve. But if they have deposit worth this much, they need to keep 3%. And for large banks who are having deposits more than 124.2 million, they need to keep 10% as the reserve with the central bank. Let us now move to the third tool, that is called discount policy. Discount policy, the formal definition is that the discount policy refers to the interest rate, that is the bank rate at which the central bank lends fund to the commercial banks and commercial financial institutions, typically for short-term liquidity needs. So the mechanism here is that lending may occur by rediscounting commercial bills, treasury bills, or directly offering credit. So it acts as a signal rate for the broader interest rate structure in the economy. So simply, if they reduce the bank rate, suppose if they are reducing the bank rate, that means the commercial banks are getting more fund because they will be borrowing more money. They are getting cheaper credit from the central bank. Then the liquidity commercial banks increases and they can lend to the general public. Suppose the objective of the RBI is to increase money supply. That means there should be more money with the general public. So if their objective is to increase money supply, then the RBI will reduce the bank rate. That means the rate at which a commercial bank can borrow from the central bank. So when central bank reduce the bank rate, commercial bank will be getting cheap credit. As a result, the liquidity with the commercial bank will increase. Then accordingly, they will get more liquidity, then they will lend to the general public. So what is the role of it in the monetary policy? So a higher bank rate discourages bank borrowing and it contracts money supply. Similarly, a lower bank rate, which I just mentioned a few seconds ago, that encourages the borrowing by the commercial banks from the central bank, and then there is more liquidity with the commercial bank, and that would expand the money supply. So in India, RBI uses bank rate and repo rate in tandem, though the repo rate has become the more active policy tool. So whenever we talk about monetary policy instrument, monetary policy, more often we talk about the repo rate, that is the policy rate that come in the forefront. So let me give you a distinction between bank rate and repo rate. So repo rate involves short-term borrowing by banks with collateral. That means usually government securities is used to manage liquidity in the banking system. In contrast to this, bank rate is for longer-term borrowing by banks without collateral. It is more directly used to influence lending rates and overall credit conditions. So I have given a summary of the distinction between bank rate and repo rate here. So you can see the similarities as well as the differences. So I am also giving you some insights about the use of discount policy in the US. So I am just here, they have primary credit rate. They also have secondary credit rate. They also have seasonal discount rate. That is for small community banks that need a temporary boost of funds. So in addition to the conventional tool, sometime during recession time, during crisis time, central bank uses unconventional monetary policy tools as well. So one is large scale asset purchases, lending operations. So I have given a description of this one. What is the financial indicators here? What are the mechanism and intermediate goals and application for India? So I have given here the unconventional monetary policy tools. I have taken this one from the writings from Dua. So in this session, we have reviewed the money supply concept. Then we discuss the monetary policy goals, and subsequently we discuss the monetary policy instruments. In the next session, we will go in detail what is the role of central bank in influencing money supply in a country, how they influence money supply in a country. We will discuss all these things in the subsequent session. Thank you for watching this video, and see you in the next session. Thank you.